Good evening, everybody. This is Ken Kavula with the Mid-Michigan chapter of Better Investing. I'm joined by my good friends, Lynch and Mark Robertson, and we're going to be putting on the July 30th edition of the Mid-Michigan Manifest Investing Roundtable. We also have Matt Spielman from Houston in the back room with us tonight. Matt's a very treasured presenter for us. We welcome him whenever he has time to help us out, and he's going to be in the back room tonight to give us guidance and maybe help answer a question or two if he gets the chance. This is an anniversary for us. This is where we began in July, and it was, what, 14 years ago now, Mark, or was it 15 now years ago?
It was 14.
14 years ago in July, we began our first roundtable, and Mark promised me that we would not have to wear costumes when we went to the very first roundtable. Now I see he has us dressed up tonight in full mail, so we'll have to clunk around in that stuff for the rest of the evening. But
and you got to admit that is a nice birthday cake.
It's a lovely birthday cake, with a lot of enough for four of us there. That's a picture of our friend Hugh McManus up in the corner right there. Hugh just works inordinately, an inordinate number of hours, and Hugh has found it very difficult in the last couple of years to get time free to help us out. We're very honored every time he can make it and talk to us about something. But Cy and Mark and I are pretty loyal. It's not that we're not busy, but we're not as busy as Hugh. I think that's the way it works. Okay, Mark, let's talk about the disclaimer real quickly. We firmly believe that everything we do in these programs is for educational purposes. We also firmly believe that we have a very intelligent audience, and that you can perfectly on your own make your own decisions about buying, selling, and holding any stocks that we talk about in real time. We, of course, encourage you to do your own homework before you make any kind of decisions. We will try to disclose if we own any of the stocks that we talk about this evening in our own portfolios. We're happy to see so many of you have taken us up on joining the Mid-Michigan guest list. That's a way to get an immediate reminder each month about the roundtable and about any other programs that Mid-Michigan is doing that are nationwide. All you have to do is go to the opening page of Better Investing. That's the blue URL in the middle of the slide. And then you have to scroll down the page. Make sure you scroll down. And if you scroll down to the end of the page, you'll see this very simple form that we've put on our webpage. You just have to give us your email address, your first name, last name, and your zip code. Hit subscribe, and you'll be added to our guest list. We promise no more than a single email each month telling you what our programs are and giving you links to register if you so choose. We also provide copies of our slides. If Mark can go back one, there we go. If you want copies of this evening's slides, send an email to Mark R. at manifestinvesting.com. And if you have questions, Mark and I are very eager and enjoy answering your questions. So send them to one or both of us. Those are our regular email addresses. And I'm reminding you that I'm a volunteer, and for these programs, Mark is acting as a volunteer. So we won't necessarily answer you immediately that moment, but we promise to get back to you in a day or two with a well thought through reasonable answer. And if we don't know the answer, we'll try to find it, or we'll tell you that we don't think there is an answer to what you're talking to us about. So let's get on to our first slide with a little bit of meat on it. And this is our performance. Mark, did you ever believe when we began this experiment that we would actually hit this +5 and then stay right around it for at least half of our tenure?
I have to, well, first of all, those of you that can't hear me quite as well as normal, I am on the road and I left my headset behind, so we're doing the best we can. So I apologize for the sound quality. I'm told that you can hear me, just not as well as usual. The answer to your question, Ken, is I was concerned and skeptical. even after, I've been through a number of personal investment club experiences, and these times right here can seem like an eternity. We were beating the market in the early days, but closer to zero. By the way, this is what an average investor experiences, professional or amateur. So we were still doing better than that, but really we had dreams of making that 5% investment club target and 5 percentage points. And as you can see, after 14 years, we do have cause for celebration. We are there. And yeah, I was skeptical. Can we get Cy to admit that he was kind of concerned about my early contributions back in the early years?
Oh, Mark, what are you talking about? We just needed patience, I guess, huh?
Patience and discipline. Those are the two words, right?
Mark will come around someday.
I'm happy to see that we were able to move into the 2 to 4% range for a fair number of years, between years 5 and 7, and then something happened in the water up around year 7.5, 8, and we moved up to that 15, and we've never really looked back. A little bit of a slip up down there in 2011, 11.5, but for the most part, we've been well above the 15, or we've been at the +5, and this is not necessarily a line at 15%. This is a line at beating the benchmark by 5 points, and Mark and I both are certain that if George Nicholson were living today, that would be the goal of most investment clubs. 15 just worked out to be a very convenient average value, that if you could do that over long periods of time, you had nothing to worry about in your club setting. But this graph is actually showing beating the benchmark by 5 points. So our return as of the end of our 14th year now is actually at 17%, and the benchmark's actually doing 12%. And we use the Wilshire 5000. That's a very large index, which a lot of folks call that the whole stock market index. And if they're at 12 and we're at 17, then obviously we beat them by 5, and that gives us a dot right on the orange dotted line. The only metric that we're a little bit behind on, and that we really would love to see move up, is our outperformance accuracy. We've been reading a lot in the last 14 years, and we know that a really satisfying, safe outperformance accuracy is up in the low 50s. Tillinghast says 55%. Our outperformance is at 47 plus right now. We'd love to get that over 50 if we can. And that's just looking at the entire tracking portfolio and asking yourself, did it beat the market or didn't it? And if it did beat the market, then it gets an outperformance ranking. And if it didn't, then it doesn't. So we're still working on that one. But these are returns as of July 30th. These are very current returns, and we're very proud of them, because while I have great respect for the stock picking abilities of Mark Robertson and Cy Lynch and Hugh McManus, I don't think any of the four of us really classify ourselves as professional stock pickers. We like what we do. We do our homework, and we have a lot of patience sometimes and a fair amount of discipline most times, and it seems to work.
Yeah, and I would add we have the guest damsels and guest knights. Herb Lemcool, Ann Manning, Kim Butcher. They have an admirable track record across the board, and they certainly have contributed mightily. And I don't know, Ken, this might have been the time frame when we started inviting more guest knights and damsels.
we don't want to make that that analysis, Mark, but we don't want to leave out Kevin Galagli and Charlene Hansen and Matt Spielman. We've had so many guests help us out at various times, graciously help us out, and they've been from all over the country. We just couldn't be happier to involve people from all over our community in this program, and and Candace Baker as well, right? And you folks that come to the roundtable every month, we get a really nice size audience, and then Mark and I are honored and flabbergasted sometimes to see the number of hits that some of our roundtable gets at our YouTube site. So while we get a couple hundred of you at a live performance, we almost immediately within the week get another couple hundred folks hitting the website and looking at it in a little bit of delayed fashion, but looking at it just the same. So all in all, it's been a very enjoyable 14 years, and I'm looking forward to number 15 now, Mark.
Yeah, and I think we'll switch to the next slide. I think one of the things that kind of caught fire back in that 5 to 7 year time frame. Go ahead, Ken.
Mark, I'm going to interrupt. We're getting a lot of folks saying that Mark is more difficult to hear than regular, and he's explained it once, but I'll explain it again. He's traveling. He doesn't have a headset, and we're doing the best we can to get his volume as loud as it can possibly be. It does sound like he's far away and in an echo chamber. And Joan, I sympathize with what you're hearing, but Mark is trying his very darndest. And if he says something really important, Cy and I will try to step in and repeat it. So that
or correct it or whatever.
Well, thank you, Cy. Okay. So we're looking at the top 20 or so in the roundtable tracking portfolio. We don't want anybody to get the idea this is a portfolio like a club would run. This tracks every single recommendation, every single stock that we've put into the portfolio since inception. We do close some of the positions when we think that they're not performing the way they should. But we track the cash flow in and out by very careful calculations. You notice up at the top there's a kind of a jumble of numbers and letters, but it's very easy to read. The 15X followed by CTSH means that Cognizant over the course of the last 14 years has been chosen 15 times. So that means that there were $15,000 originally put into the $27,000 that Cognizant is now worth today. Some of you might be looking for Microsoft. It's over there in the 5X group. So we've put 5,000 into Microsoft, which today is worth $108,000. We've shown slides before, and we might show slides again that say that this one home run, this one Microsoft home run has been enough to balance out almost every single loss that the portfolio has. Mr. Lemkool, our esteemed Mid-Michigan director from Traverse City area, has given us two chances to invest in NVIDIA. Maybe we have 3 now. Do we, Mark? We do. We have 3 now. So NVIDIA is in the 3X column, but that $3,000 has grown to $41,000. And you can see down the lines here, the really interesting one, and it's still on the list, is Costco still with us on the list, Mark? There it is. That's a single position in Costco. That's a $1,000 position that is now worth $17,000. And one of our biggest regrets is not putting more money into Costco the few times that it certainly was in the buy zone in the last 14 years. That's just one heck of a behemoth to deal with. We've been really trying to stress a sentence that Mr. Nicholson wrote in a couple of the investor handbooks for better investing that says, be very wary about selling any company that's growing in double digits over long periods of time, even if the current potential is less than you might want to expect. Be very wary of selling something that's growing its sales better than 10% and growing its earnings better than 10%. Keep them around for as long as you can, or if you have to cut them back a little bit, keep a little bit of it in the portfolio, because those are the kind of stocks that are really going to, in the long run, return the kind of money that will give you a very secure nest egg. Mark is putting red dots there in our top 20 about the growth numbers, the sales growth numbers. And this is a pretty healthy growth number for the entire portfolio of 13%, almost 12.7%. We think that Mr. Nicholson would be very proud of this example that we've put in front of the community that he helped establish. Mark, what do you have to say? Anything? I'm doing a lot of the talking right now.
Well, I'd have more to say, but nobody can hear me.
Okay.
A couple of things. I think, yeah, Microsoft, those 5 positions in Microsoft date back almost 12 or 13 years on average. So that is part of that catching fire that you see there in the middle of the chart, 1/3 of the way across the chart. And a lot of these have been held in this portfolio for many years. And Costco goes back to 2012 as an example. So sometimes it takes time for these things to come around. And as Sia likes to talk about patience, patience really does work with this methodology. That's all I got for now.
Well, we've beaten this slide to a bloody pulp, so let's move to the next one, okay, Mark?
Well, I was going to help beat it up. I was going to help
beat it up a little bit more. Go on, Si.
a little bit.
Yeah.
I just wanted to point out, because Mark was marking the double digit or the near double digit. Notice Cognizant. Notice EPAM a little farther down, 6.1. And Infosys at 4.6. All of those, for most of the time we've held them, were solid double-digit growers, and in fact, historically still probably are, as far as I know. All of them are. But what I was pointing out there, that is just indicative of the current street view of the consulting headwinds in the industry. I mean, notice all of those companies are taking significant projection hits in growth.
Mm-hmm.
But it's also indicative of the increasing competition in that space too, don't you think, Si? The entry of a lot of newer companies into that space that are putting a little pressure on margins for some of these companies too.
Very much so. All right. Any more things to stress? I mean, the portfolio overall, good growth rate, excellent quality on average. That does allow us to have some speculation stocks amongst the critters. We would like to see a little bit more return forecast. And we'll be trying to help that a little bit tonight. But at some point in time, we're going to have to lighten up on some of the lower return forecasts in the future. And we will. All right. So,
Mark, I just heard that Si is having audio problems.
Yeah.
Si, are you with us again
yes,
right now?
I'm
okay,
back.
Great.
So.
Okay. I think we're going to start right in on the stocks that we're going to talk about this evening. So I'm going to turn it over to Si, and it looks like on this first slide that his first pick is Gentex. So go ahead, Si.
All right. Hopefully sound will cooperate. Yes, Gentex is my pick tonight, and the reason that I did, it took a little bit of a hit a few days ago. Let's see, this is Tuesday, so it's probably Wednesday or Thursday when they gave some June sales numbers that the market didn't like a whole lot. I will also, while I'm thinking about it, I do own Gentex and have owned Gentex for many years, probably off and on, perhaps, but in any event, I do own it in my personal portfolio. Here you could see a good, consistent grower, certainly on the sales side, with the exception of the COVID time frame that you'll recall had a lot of negative in the auto industry and the like, which is their primary market. And you could see at the lower right, value line has certainly some midterm and long-term favorable views of the company. So let's unpack it a little bit. Next slide. First of all, as usual, I'll mention how I got it and why I decided on it. I just took a look at the round table, ranked by par, and you see Five Below is pretty high there. I considered Five Below in mode. I think I have brought once. I think Ken's brought it. I think possibly even Bart. It's been brought a few times in the last 6 months or so. I considered it. I brought CVS a couple months ago at Bink, but just decided none of those quite struck my fancy. And I hit Gentex. And believe it or not, although it has long been a community favorite, and as I mentioned, I have owned it for many years, I can't find a record of me ever bringing it to the round table. You can see it's, yeah, I don't know what's wrong with me. I missed it. Somebody's been bringing it. As you can see, it's 10 times, and I think it got brought maybe even Bink this year. I know it's been brought fairly recently, but nice things to jump out. Good potential return at 15.7, 100 quality, can't get better than that. Earnings stability, financial strength, solid growth rate right at the double-digit side, and a pretty reasonable PE. So I said that catches my attention, but let's just make sure there's nothing else out there. So next slide. I did a screen basically using 90 quality and a 90 financial strength. And here you go. A few holdings in the portfolio, and Gentex ranked third in the par and had other attractive features over this, although this is an excellent list that you see. Next slide. My final comparison was, let's check out the industry. I ranked the auto parts industry is all over the place as far as returns and quality. So I ranked by quality. And again, you could see that Gentex rises to the top quality-wise, but it's also among the best return combination, high quality, high potential return. So I said, let's look at Gentex. So next slide. Quick review of what the company does. It's been picked 10 times, as I said, fairly recently, and it's a community favorite, so I won't delve too much into it. Just very quickly, historically, it started out as a fire protection system, smoke detectors and the like, and it developed from that sensing technology, moved into glass mirror dimming, auto dimming glass, and that's their primary product now. Automatic dimming automotive mirrors, inside and outside. They control, or they have about 90% of the market. They've been dabbling for a number of years in dimmable aircraft windows, and they still do have commercial fire protection products, which that confirms my suspicion. It was Bink that someone brought it, because I remember going back to my hotel room, because I have noticed Gentex products in hotel rooms, but the Marriott in Chicago at O'Hare was not a Gentex product in the room. And what they're doing right now, management is seeking to leverage their core competencies and look for emerging technologies, particularly, again, in the automotive area. Where is the automotive market going? Where can we further our expertise, our core competencies, if you will, to expand, but also being innovative with their current products. Next slide. Here's just a graph of the company from 1987 showing their growth in mirrors. The IEC is interior, you know, your windshield mirror, and then your outside mirrors. My car, I own a 1921 Honda Clarity. I know the inside mirror is Gentex. I don't believe the outside mirrors are. And as you can see, they sell far more inside than outside. Next slide. This graph, this just shows the bars are the vehicles produced worldwide, and the blue line is the Gentex revenues. And as you can see, they are somewhat, of course, as you would expect, sensitive to the numbers of vehicles produced. But as they're anticipated, if you notice between 23 and 24, the market for vehicles is slightly down, yet Gentex expects to penetrate more and have more sales. And they've grown a little bit faster recently than coming out of the COVID recession, have grown a bit faster than the sales. So that's the company's strategy, is continue to grow even if automobile sales are not growing. Next slide. And here's them looking at what is our technology, digital vision, and they're leveraging that some in home monitors, baby monitors, and the like. Of course, the dimmable glass, connectivity. Again, if you have a Gentex product in your car similar to mine, you may have some ability to connect to smart home devices. At least I think it's mostly my car level primarily, but my home is not much smarter than I am to this point. But my garage door opener is operated by a panel in my car that is a Gentex related.
We lost Si's audio.
You give him a second to recover and see if he.
Okay.
And while he's away, I would like to assure the audience that he is a very frugal guy, but I do not believe he's driving a 1921 automobile. Well, I hope we get him back. We can always skip ahead to yours and come back to slide 13 if we have to.
Okay, why don't we do that, Mark? Okay.
Okay.
Put a bookmark in that, folks. Okay, and we're going to move on to Schlumberger, ticker SLB. That's a picture of the offices in Houston. It's an American company, one of the largest in the world. If it has anything to do with exploration and drilling of oil and gas, or the transmission of oil and gas, and a lot of the other associated things that you do with oil and gas, Schlumberger is probably providing materials and services to help make that more efficient. First slide, if you would, Mark. Schlumberger has been on a real tear in the last 3+ fiscal years. They have focused on expanding their margins, and to do that, they've set out to make strategic acquisitions Schlumberger was not known for being a very acquisitive company in the past, but in the last 3 or 4 years, they have made major acquisitions, and you can see that it's resulted in some pretty hefty growth from 2021, the bottom of the pandemic, all the way to the present time. You can see the exploration of the upstream spending moving 43% over that time period. Their revenues moving 60% over that time period, and their EBITDA moving 85% or more over that same period of time. Again, this has been a conscious decision to grow margins, and to do it by making some very, very large acquisitions. Next slide, if you would. The one that's in the process of closing right now is an acquisition of ChampionX. And ChampionX has a lot of technologies that Schlumberger was a little bit light in. They're also a leader in the Permian Basin, where Schlumberger did not have as large a presence as it wanted to have. And they decided they were going to buy this company. And back in 2021, at the bottom of the pandemic, Schlumberger set a goal to increase EBITDA, earnings before interest, taxes, depreciation, thank you, and amortization. And they set out to make it go greater than 20. The white line was their goal. That blue line is where they expect that to end up by the end of 2025. So they really have boosted margins, and most of you understand accounting well enough to know that if you get a higher margin, then you make more profit, and if you make more profit, your stock price improves substantially. So this, they're hoping to close this ChampionX acquisition before January 1st, 2025, and if they do, then they're looking for really, again, another jump, another boost in the percentage profit on what they're making in their sales right there. This is the large one. If you read the current value line report, you'll also find that they're also made a number of smaller acquisitions. And Value Line focuses on a couple of those acquisitions as being smaller, but nevertheless extremely strategic in helping Schlumberger meet that goal of increasing their margins. I would urge you, if you're interested in this company, to not only look very carefully at the Value Line report, but also take a serious dive into the Morningstar report. I know they're long, I know they get bogged down in a little bit of detail occasionally, but the Morningstar report is extremely positive on this company as well. Again, this is the management speaking now on this slide, but they have put their chops into focusing on margins and returns to the shareholder. And they're just telling you some of the things they've done since the bottom of the pandemic, again in 2021. And they're very proud of the fact that they're going to be delivering on almost every single promise they made 4.5 years ago, and they're going to deliver on that by the end of 2025. They're bringing AI into a lot of the technology, but who isn't? I couldn't point to anything specific, but I noticed that they like to salt all of the comments here with the letters AI, and I don't know what to make of that, but that's been true of almost any company we're studying recently. They are doing a lot of work in consulting, and Schlumberger used to be known as an equipment kind of company, and more of their business now is digitized. More and more of their business is in consulting and helping firms do what they do with energy in a more efficient manner, and then providing them the tools to make that happen. Next slide, if you would. Here's what the last 10 years have looked like. And like any other energy company, earnings can be a roller coaster. This is a cyclical company because it follows a cyclical commodity. You'll notice that the long-term trend on sales over the last 10 years is actually down 4%. But the company feels that it began a renaissance, a rejuvenation, a realization of more profit margin and a whole new company. They feel that began in 2021. So next slide, Mark. Here we are looking just at 2021 going forward. Remember that the dots that are provided on the graph are coming from a Morningstar analyst or a group of Morningstar analysts, and that's a single opinion. It happens to match fairly closely the opinion that I finally came up with after referencing a large number of sources. I'm very happy that Morningstar and Value Line and CFRA and some of the online digital sources are all basically saying the same thing about this company. They're expecting sales growth somewhere in the 12 to 16% range, and they're expecting earnings growth somewhere in the 13 to 20% range. So I think the numbers that I've chosen are very representative of the experts that are out there. Schlumberger is not trading near the top of its 52-week range right now. It's trading near the middle, or actually a little bit below the middle. I can tell that where Mark's pointing up there right now. And I've chosen 14% sales growth. And then by choosing 14% future sales growth and using the preferred procedure, I'm ending up with 15% future earnings growth. I really like it when I see three greens in the evaluate management, although I probably would strike the 2019 and 2020 numbers as being unduly affected by the COVID pandemic, and I'd basically be looking at the last 3 years, and they're all really decent numbers. Notice the increases in margins going on by this company from 21 at around 10% to 23 at around 16%. Notice that they're doing it on fairly acceptable debt to capital. It's a little bit high, but it's really moving down in a way that will take it back, I feel, to the debt numbers that they were carrying in 2014 through 2017 or 18. I think they're headed in that direction. The return on equity, I think, is more than fine, especially the most recent 2 years, both of them, 22 at 20 and 23 at maybe 21 plus. So I don't find much not to like on the front of this SSG if I'm buying the thesis that there's a renewed interest in returning value to the shareholders, and that means a renewed interest in increasing margins. Next slide. I've chosen what I consider to be very reasonable PEs going forward. I'm looking at the high PE column, and I chose 22. The high PE has averaged for the last 3 years when they were making money at 24, so I think 22 is certainly reasonable. The same thing at the low end. The average for the last 3 years has been around 14. I'm at 12. That gives me, if you add those together, you get 34 divided by 2. That's a forward average PE of about 17. And that's what I'd like to compare when I look at sources like Value Line or look at sources like Manifest Investing. There are other sources that give you their call on the average PE in 5 years, and my call is around 17. It certainly sits in the right ballpark. By using these particular values along with a payout ratio. If you look over in column G, you'll see that the payout ratio is somewhere maybe around 33, 34, 35, 36%, somewhere in that range. And I'm using a payout ratio that's equivalent to the low to mid 30s on this SSG. I'm getting a good solid buy with a pretty decent 7-to-1 upside downside ratio. Next slide, Mark. I set the payout at 36. I'm getting a buy. I'm getting 18.6% par. That's if I sell it at that average PE of around 17. If I manage to sell it at the highest PE of 22, I could make as much as 24%. Remind yourself that this is an extremely large company, and these numbers are exceptional for a company this size. Next slide. I'm very comfortable with the analysis I did. I've shown you the analysis that comes from Y charts. That's what Mark does in Manifest Investing. He's calling around 18% par. I'm showing you where value line is sitting. They're calling for high-low values in the next 3 to 5 years, somewhere between 14 and 26%. I think my 18 is certainly in that range. And I like the fact that Morningstar sees this company as undervalued enough so that I could make $13, $14 just to bring it back to fair value. I don't even have to look at it going past fair value to make any kind of a decent profit in the near term. So I'm very comfortable with what I'm putting out there, and I'm suggesting that we put Schlumberger, $1,000 of that into the tracking portfolio. Has Cy returned to us? Do you know, Mark?
I think he has.
Okay, then let's go back to slide 13 on Cy and see where we're at. Cy?
All right.
Okay, here we are.
All right. Yes, thank you, Ken, for holding down the fort. Obviously, Gentex is such an exciting candidate tonight that the forces of nature didn't want our production to go through. And in fact, I have had my computer normally hooked up to uninterruptible power supply, and that went on the blink earlier this week too. So in any event, we're back. Here's the dimmable device platforms. I think this was the slide after what I was talking about. Again, just the technology path. They're expanding past mirrors in vehicles, dimmable sunroofs, visors, of course, the aerospace, and that sort of thing. Next slide. Again, they're trying to expand out of automotive, really not expanding into fire protection because, as I mentioned, that's really where they started. Yet they are kind of moving back into fire protection on a little bit bigger area, increasing home monitoring and so forth. Perhaps the most recent kind of potential expansion areas in the medical field. They're looking into medical monitors and the like. Now, again, those three areas to the right, those are all areas to watch. They're all things that the company is doing. They're putting assets, but 98% of their revenues is in that automotive area. So these others are just out there as potential growth opportunities, but it's really what they do in the automobile. And as I've alluded to earlier, they're expanding beyond just the mirrors into other aspects of the vehicle, tying your vehicle to the car or to your home, garage door openers, light controls, that sort of thing, and then more things in the car. Next slide. Just one of the challenges that Gentex recognizes, and anyone knows, they say the industry is in flux. Digitalizing the electric or EV area and then autonomous driving. Basically, Gentex's answer is the next slide. We're powertrain agnostic. They ship mirrors to manufacturers of EVs, hybrids, plug-in hybrids like my car, and just traditional gasoline powered. Although their primary customers, as I do mention here, are tech focused. They, I believe they sell to about 25 or 30% of the manufacturers right now, and they're trying to be selective who they sell to. Although in the auto dimming market, they're by far the Goliath with 90% of the market. Next slide. They also say that they're somewhat driver agnostic. They are working with the dimmable mirrors as well as the home link and connections, dimmable devices outside of the mirrors that would potentially impact, of course, passengers in driverless vehicles, or as you can see here, the sensors and things that can help navigate or drive driverless vehicles. So they're also trying to prepare for the driverless vehicle market as well. Next slide. And then kind of wrapping things up before we jump back into my judgments, the company generates a lot of cash. The company has a lot of cash on its books. Here's how they plan to use it. They've got capital expenditures, expanding their manufacturing capabilities and so forth as they grow. They pay a healthy dividend, although it's not an extraordinarily high. It's between 1% and 2% a year, and they expect that to remain about the same until they get back to record net income. They do have M&A acquisitions. They are acquiring some smaller companies to help again expand their technology areas, and they do repurchase shares. They have done so historically, and as you can see here, they've got a significant chunk authorized now. Now let's get back into the judgments and analysis of the company. Here's just the history again. You've seen the graph before, but you see historical sales have averaged 3%, although that's with a little bit of flat before the COVID downtrend, and they've come out of COVID very well, and you could see projections going forward are solid. I used an 8% sales growth projection and worked out on my preferred procedure, which I think is the next slide, to 10.5% or $3.11. Here's the preferred procedure calculations, anticipating expenses to stay about the same. The company's has taken a bit of a hit in profit margins. It's a bit lower than historical, and they're seeking to expand their gross margins, which of course will come down to the net margin as well. And then you could see I'm projecting some share buybacks for the $3.12 a share compared to manifest, a little higher at $3.57, and the better investing median for our community is just a tad below at $3.04. Next slide. PEs, I went pretty much with the 5-year average for my high PE. I took the low of over 10 years as a potential low, because while Gentex is largely a growth cyclical, it is certainly operates in a cyclical industry and is susceptible, as you can see, somewhat in those charts. And as they just discovered, the reason that Gentex pulled back a few days ago was they released June sales reports that missed their targets. And the explanation was the automotive makers, unanticipated by Gentex, cut their production levels in June. And so they have adjusted their expectations for 2024. I think they cut sales by about $50 million, which on a $4 billion or so company is not a whole lot. and they tweaked the margin down, I think, by 0.5 percentage point, which again, when your gross margins, and this was gross margin, is in the 30% plus range, that's not a whole lot. So there was a hiccup in June, but everybody expects that to correct itself going forward, and this could be certainly a potential buying opportunity. Next slide. And so here's my final judgments. As I mentioned, the yield is 1.5 to 2%. You get, using the high PE, a 19.5% potential return. Using the average PE of 17, you get a 13%. And again, there's a little bit based on a manifest consensus. There's perhaps a little bit of reason for upside to that. It's just a little higher because it's based on a little bit higher growth projection than my 8%. I think it's 9 and 9.6 or so. We used roughly the same PEs tracking through. So I'm saying let's go for the big double-digit 11. Or I guess actually it should be 12 after the audience adds their share.
Man,
Thank you, Cy. Thank you.
we knocked him off the air, and he still comes back strong.
We do have one question. I'll say maybe I'll ask it so it doesn't look like Ken's trying to sabotage anything.
Oh, okay.
You did cover this. If we go to the SSG section 1, you did cover this briefly, Cy, but Tom asks, how do you explain the pre-tax profit drop from 17 to 23?
Most of that is attributable, because if you notice, it was flattening out after 17, so that I don't have a particular explanation for that area, but the 19 dipping really into up to 23 is a significant supply chain issues. They were having difficulty getting some of the supplies and having to pay more, and some downward pressure in what they were able to sell. And that the company has targeted increasing the margin. And as you can see, they've brought it up in 23. I think they're projecting 24 to be up a little, but mostly flat. But then they're seeking to drive it up into 25. But it's significantly related to their supply issues.
Yeah, I think for the industry that can be kind of confusing, because the industry, I think, surprised a lot of people that they did very well in the pandemic, despite supply chain issues. But that was because they went and basically fully concentrated on trucks, on very high priced items.
Right.
When you think about a supplier and the overall production volumes of the whole industry, they were still down quite a bit and constrained on their supply chain. What they did is the automakers focused in particular all their microchips. You remember the big thing about the chip shortage,
Right.
into trucks. And so for Gentex, that's still going to look like a volume decline.
Exactly. And also, while again, I call Gentex a growth cyclical, you will notice it, but Gentex is a manufacturer. So they have significant, overhead and capital expense to maintain just their plants. So when you have a dip in sales, as you had in much of that time frame, that it will also squeeze profit margins. It doesn't just, you get with cyclical companies, you kind of get a double whammy on EPS. The sales, your top line goes down, but it also compresses margins frequently because their fixed costs stay the same, but their revenues come down.
Absolutely.
Thank you, sir.
Thanks. All right, I'm going to go ahead. Is it my turn, Ken?
It's your turn, Mark. Okay.
All right, let's go back and make another selection of Novo Nordisk. I'm going to say it that way. I think that's the right way to say it. The company is Novo Nordisk. The ticker symbol is NVO. Just again, just like Cy, a little bit of quick background. I ran a quick screen for companies that are very highly ranked in terms of their quality and projected return. This turns into a pretty nice shopping list. Also wanted core scores above 240, more on that in a minute. I do notice that a couple of those Israeli companies end up at the top. I believe I selected Nice Systems either last month or the month before, but there's been a couple of selections there. And InMode also has Israel-based operations. I do think that the rather affirmative response, and that's all I'm going to say, to the recent incident in Tel Aviv probably slows down some of that activity in the future. They made a massive retaliatory strike against the people they thought that were responsible for the most recent incident. So I think those companies probably are depressed from a stock price perspective because of the challenges in the country, and just something to watch going forward because they seem to be doing pretty well in the face of the challenges that they have. Yum China, still like the company. I keep nibbling at that and wanting to go back to it, but I wasn't in the mood for that. I'm also not in the mood for Lululemon at this point, so I was kind of losing interest. I do like this one, Ken's selection from last month. That one kind of pulled on me a little bit, but I said, tell you what, let's go back and look at this notion of core companies. We looked at this during the bull session this afternoon, and the companies on the left are the 20 lowest companies with respect to what we call the core score. And that is simply the sum of the financial strength index, the EPS stability, and the quality ranking. So these are going to be companies that probably look the worst on a stock selection guide. And I will confess that I have been burned by adventures, and I'm using air quotes right now, Ken, adventures into places like Emergent Biosolutions, which I've mentioned on a couple of panels in recent years. And I still don't understand why these guys can't seem to generate a decent business model output. But they are down here, and there's others on this list that are just simply very, very challenged. There are others that are very early stage, and sometimes it's hard to tell the difference between some of these. But these over here can be very frustrating adventures. Some of them can be very rewarding, but the ones on the right are the top 20 core scores, starting at the highest and just listing the top 20. And this is a pretty good shopping list. We went through this afternoon and discovered that most of us own 7, 8, or 10 of these in our personal portfolios. And these are going to be the type of companies that generally have pretty good looking visual analysis, pretty good characteristics about the company. You can see that my selection here tonight, Novo has strong characteristics across the board, ranking second amongst all companies. And this is just simply a real nice place to go shopping. We basically believe that we should be accumulating any of these when they are demonstrably attractive and on sale. So with that, I just ran one more quick screen. I wanted to screen for companies that had a core score near the top of the pack. And you can see that, yes, size Gentex ended up near the top of the pack. So did Novo, Visa, a fairly recent addition to the portfolio. And then, of course, our largest position in Microsoft also scores pretty highly at this point in time. So let's talk about these guys. Novo is the company that has historically provided insulin as the predominant product for a number of decades. They have recently gotten into the current weight loss fad with these, what they refer to as GLP-1 products. I know this is not news to any of you out there. That's what GLP-1 stands for up at the top. I cannot profess to be an expert about any of these impacts. All I know is that they are discovering that with respect to diet, weight loss, and a number of other conditions, they're starting to see benefits in a number of different areas. And Novo and Eli Lilly are amongst the best positioned with respect to this particular solution to these challenges. In fact, Novo came out recently with mental health benefits. You can see they do have the brain up there, so it'd be kind of cool. Also, just within the past week, Eli Lilly claimed some sort of breakthrough with Alzheimer's. So these are all good things happening, and just a lot of good things that could come from this. As far as the big overall picture, I don't think this is surprising. I am an expert in this area. I keep losing weight and finding it. That's no fun at all, but obesity rates in the United States do continue to ramp up. And if you're wondering about, well, surely that got better with COVID, it didn't, it got worse. And it's actually been a fairly stunning increase, and they probably need a scale change on the graph on the right. So it is quite a challenge facing all of us. And in case you're wondering, is it a problem limited or a challenge limited to the United States? The answer to that is also no. We basically see a worldwide trend, and companies like Novo and Lilly are attempting to address it along with others. Roche, one of the longest term holdings in the roundtable tracking portfolio, came out with an oral medication here within just the last couple of weeks. So it's an area of tremendous challenge and significant opportunity. Novo seems to address many of the key challenges pretty well. Here's a look at the actual product. I have friends and family that are actually using this and experiencing a significant weight loss and a fairly decent experience. So this is the Novo product, Ozempic, that makes a lot of the news broadcasts and some of the sensationalism, but it does seem to be working. And in talking with experts in the healthcare industry, they really do believe that, in fact, futurists, they actually do believe that we are going to come up with maintenance solutions where the weight is not regained by all of these patients and clients. So again, this is an area that Novo is working very diligently on. How do they manage the longer term care for these situations? Here's a look at the stock price chart. It's a long-term chart going back 10 years. And you can see that it's been a fairly steady increase over the last several years. I think the GLP-1 stuff broke approximately 3 years ago, is what I'm guessing, somewhere back in this time frame. And it's been going pretty good ever since. One of the things that I want to convince the audience tonight is this is the type of company that doesn't necessarily get to a 5 percentage point advantage to the stock market very often. As of this evening, the average stock out there is running at about a 9 to 10% return forecast, and that would mean that we would be out there searching for 14 or 15% returns for the companies. But this just might be one of those type of companies that doesn't get there that often. And this is a long-term look. We refer to this as chronicles. The green bars are the stock price, the same stock price that you see on this chart, only represented here. The blue is the actual quality of the company. This is a very healthy trend, basically saying that they're responding to growth opportunities and capturing profitability quite well over time. The middle one here is the variations in the return forecast. Think of it as section 5 of a consensus stock selection guide. And what I want you to notice that over the years, much like a Johnson & Johnson or even an Aflac, they very rarely get up into that 15% range. And right now, they're basically operating at a point which is relatively high, even going back and looking over the last 3 to 5 years. So again, this is the type of company that I don't think you get that 18 or 24% buying opportunity very often. And I'd like to see it a little bit higher, but it's up in double digits and attractive for accumulation purposes. Here's a look at the company. Again, that very nice quality trend. You can see that the projected annual return is operating up near multi-year high levels. You can see that the gains with sales from the GLP-1 situation results in a growth rate that is in the mid-teens. So we're talking about a mid-teens growth rate with earnings also probably in the mid-teens. We'll look at the PE in a minute, but a PE somewhere in the upper 20s or perhaps even low 30s makes a lot of sense. There's a lot of upstraight and parallel to this. Again, you see this inflection with what has been happening with some of the areas that they are now beginning to serve. The business was good. Going back over the last decade or so, it's gotten better than good here over the last couple of years with expectations for the next couple of years. So you're looking at a double-digit projected annual return for an extremely highly ranked quality company and a pretty good situation. And again, here is a look at, does a PE of 30 make sense for this company? I would argue that with the GLP-1 situation, it's been operating in that range. And I don't think of a PE in the neighborhood of 30 is science fiction for a company like this. I would cite the incredibly consistent operating margins. Again, trucking along at approximately 50%, and their bottom line net margins, basically their earnings, also very consistent in the mid-30s. So value line is a little bit lukewarm on the company, but that is a low total return forecast. Morningstar, for some reason, just causes me to scratch my head. I'm not with them on that expectation. The analyst consensus expectation is that the company is 16 or 17% discounted to fair value. And most recently, the stock price has been a little bit turbulent. So we do have a fairly near-term opportunity to capture it at a slight uptick. And then just the most recent value line close. It's not just about the weight loss. There's a lot of indications that we're seeing benefits to all kinds of different areas, cardiovascular, osteoarthritis, just some really nice fields of opportunity that they are carefully exploring. And again, as it says here, they do have above average 18-month prospects with an incredible safety rank. So I'm going to go ahead and recommend that we go ahead and accumulate another position in Novo Nordisk, ticker NVO. So with that, Ken, I think we can go to a poll.
Okay, if you give me just a second here, Mark.
And I believe NVO is going to be the middle option on your voting, on your ballot. I think that's right.
There we go. I'm watching you vote, folks, and we're up to 50% voting. We'd love to get around 85, 90% if we could. We just hit 80. So I'm going to kind of count to 10, and then we'll close the voting. And we made it to 85. We can get another half dozen of you. We might move it up to, that looks like the end. So here we are closing, and let's display the results. And Mark, this is 2 in a row for you. I don't know what's happening, okay? All right.
Get up there and buy a lottery ticket.
I don't know, but that's two months in a row we've chosen Mark's stock to add a second $1,000 to. I certainly think Novo is an extremely interesting company with real bright prospects. And I think we presented 3 really good ideas to you tonight, folks. So let me drop this off. You're all seeing that, so let me close that now. And Mark, you want to bring us home if you can?
Yeah, I just want to remind everybody that we do archive these presentations, whether they're bull sessions or roundtables. You can see the roundtables right down the middle there for previous months on the YouTube channel. If you go to YouTube and you search on Manifest Investing or Roundtable or bull sessions, you will find this page, and you can actually go back and go back as much as 12 or 13, I think almost back the full 14 years, and see the sessions in the past. some of those are huge doses in humility, by the way. Want to go back and look at some of those first 3 or 4 years? Not fun. I won't be with you. But you can actually do that. And then also, we do put some of our special educational presentations. You can see part of the Getting Started series down there on the lower right. And with that, I think our next function, Ken, is with the August roundtable. I had it as August 27th. You'll have to double check me on the date. But Cy, don't you got
That's the correct date, yep.
Cy, you've got a Georgia chapter function coming up
Yes.
that I believe Kevin Galoglu is a part of, and a couple others. Could you
Right,
go ahead and tell us
Kevin is
about that?
part. Yeah, that is the Saturday before the round table. I believe the 24th is the date. And yes, the 27th is also correct. So the 24th is the Saturday. That's Georgia, Kevin Galoglu, and I'm presenting. And then there's another couple of presenters. So if you go to the Georgia chapter Better Investing site, you can get the information and the registration information.
This one, just to
for
be clear,
that.
this one's online and available to the general public?
Yes, that
Okay.
I'm sitting here telling you, you can go on. Of course, you're free to hop on a plane and come to Georgia when they're in person too. But yes, this is a virtual program, so anyone, anywhere can join in.
Fantastic.
And be part of that.
We'll put that up on our site too, and encourage people to have a back to school session with some friends.
And
As
I will
always, I'd
prob-
like. No,
I
go
was
on,
just
finish.
saying, I'll probably be eating food in Las Vegas, getting ready to go work with cats the next round table. So I will probably miss y'all, but we'll have the Georgia send off on Saturday.
Cool. All right, Ken.
As always, I'd like to offer a great big thanks to Mark Robertson and to Cy Lynch for helping out. We could not have done any of these roundtables, Mark, without your help. You know that. And more importantly, I know that, and so do the folks in mid-Michigan. We're so thankful that you've offered to be our sidekick and to help us out. Cy, we can't say enough about how much we appreciate what you do. And Matt, you're becoming an indispensable part of the roundtable here. In fact, Matt, if you have the 27th free and Cy has just indicated that he's not going to be able to make it, why don't you drop me a line if you're available to present something on the 27th, okay?
Yeah, that might work
With
out.
that, okay, great. And with that, I'm looking at questions. We don't have a lot of questions. We've been answering a lot of them in the back room right here. So unless I see something come up in the question box right immediately, we're going to apologize again for the sound quality, but there was just nothing we could do about the sound quality this evening, folks. We hope to all be back in our regular positions in August, and we'll have better sound for you. And with that, I'm going to say good night, best wishes. And for those of you in the northern parts of the country, you have about 6 weeks of summer left. Make use of them, okay?
Absolutely. Thanks, everybody. It's been a good 14 years.
Yep.
Let's keep piling on.
Thanks a lot, everybody. And great job, Ken, Cy, Hugh, Mark, Hugh peeking in, and then, of course, certainly glad to have Matt with us tonight as well. So,
Enjoy your cake, gentlemen.
Good night, everybody.
good night.